Twice a year, CBRE releases a semi-annual cap rate survey, which gives a really helpful snapshot into what the investment and brokerage professionals at the biggest commercial real estate firm in the world are seeing as far as current pricing levels and where they see pricing going in the future based on recent transaction activity and the overall sentiment that they're hearing from buyers and sellers in the market. And earlier this month, CBRE released their most recent report for the second half of 2022, which included more than 3,600 cap rate estimates across 50 geographic markets throughout the US. And even though this information is already a little bit stale at this point with how quickly the market is changing, this data can still provide some really helpful insight into what's been happening across the country in multiple different markets, across multiple different asset classes, and where things might be headed throughout the rest of 2023. So in this video, to drill down on what I saw as the most important aspects of this report, in this video, let's talk through where cap rates are today, where they might go in the future, and what this all might mean for you as a real estate investor or industry professional, and the opportunities that might come up in the future as a result of all of these changes. So the first thing worth noting in this survey really comes as no surprise given the huge spikes in interest rates we've seen over the last year, and this is that estimated cap rates increased by an average of 60 basis points across all asset classes and markets tracked from the first half of 2022 to the second half of the year. But just like any average figure, this wasn't indicative of how all markets performed, with some of the most popular asset classes and US metros seeing significantly bigger cap rate jumps over the last 6 months. Industrial real estate has been one of the best, if not the best performing asset class since the start of 2020, and Class A stabilized industrial assets in many markets saw significant cap rate increases in the second half of 2022, with 54% of metros tracked in the report seeing cap rate rises of 125 basis points or more over the last 6 months, including in some of the hottest real estate markets in the country like Atlanta, Austin, Dallas, Tampa, Phoenix, and Denver. And as for the other most popular commercial real estate asset class over the last 3 years, multifamily took an even bigger hit in many of these same markets, with Class A stabilized infill apartment projects seeing cap rate spikes of 150 basis points or higher in cities like Boston, Denver, Las Vegas, Phoenix, and Salt Lake City. And with these two asset classes starting out the year with the lowest cap rate values within the entire industry, and many markets seeing multifamily and industrial cap rates in the low 3 and 4% ranges throughout the last 3 years, even small increases in cap rate values have had a huge negative impact on property valuations. And while cap rate compression or falling cap rates in the market can be a great thing for investors who own commercial property while rates are decreasing, record low cap rates can also be a double-edged sword, and if you don't end up getting out at the right time before cap rates start creeping back up, property valuations can drop extremely quickly, and equity values can drop even faster depending on the amount of leverage used on the deals that you own. And to use the Phoenix market as an example of this, in the first half of 2022, cap rates on industrial Class A stabilized assets jumped from 3.5% on the low end and 4% on the high end to 4.75% on the low end and 5.5% on the high end in the second half of the year, meaning that assuming that NOI value stayed constant throughout this 6-month period, industrial investors would have seen valuation decreases of anywhere from between about 26 and 27% during this time. And for Class A stabilized multifamily infill product, cap rates hovered between about 3% on the low end and 3.5% on the high end in the first half of the year, but by the end of the second half of 2022, multifamily cap rates in Phoenix had risen all the way to 5% on the low end and 5.25% on the high end, leading to valuation drops at the same NOI values of anywhere from about 33% on the low end to 40% on the high end just during this short 6-month period. And again, these figures assume that NOI values stayed constant over the last 6 months, but according to the Yardi Matrix Multifamily National Report for February, multifamily rents in Phoenix actually saw negative 1.2% year-over-year rent growth during this time, which means that value decreases have very likely been even bigger than this, especially as inflation has caused operating expense growth to be at 40-year highs in many US markets. And while these pricing changes definitely aren't easy to swallow for investors, this becomes a lot more alarming when you take a look at changes in investor equity values during this time, even those investors that used what felt like very conservative leverage levels in 2020, 2021, and even early 2022. At a 65% LTV ratio, again assuming NOI stayed constant throughout the second half of last year, equity values for industrial investors would have dropped by anywhere from 75 to 78% during this time, and equity values for multifamily investors in Phoenix would have dropped by anywhere from 95% to 114% over the last 6 months, essentially wiping out all investor equity in a property in less than a year. And this is especially important because many of these assets were not only financed with debt, but were also financed with short-term loans that are going to need to be refinanced in the next 12 to 24 months at significantly higher interest rates and significantly lower valuations, which may lead to refinance proceeds actually being less than the outstanding value of the existing loan at the time of maturity and requiring equity investors to come out of pocket just to hold on to the properties that they own. What's also really interesting to note here is that big increases in cap rates have the biggest negative impacts on the asset classes with the lowest cap rates to start out with higher starting cap rates or valuations based on lower multiples of NOI, resulting in smaller valuation drops when cap rates rise, which could actually help investors in what have been considered weaker asset classes over the last few years, including office and retail properties that have traded closer to the 5, 6, and 7% cap rate ranges versus the 3 to 4% cap rate ranges that we've seen for multifamily and industrial. And to illustrate this, using an example, if we were to just use the average cap rate increase between the first and second half of 2022 of 60 basis points, assuming all else stays equal, at a 3% starting cap rate and an 80% LTV ratio, a 60 basis point jump in cap rates would result in investors losing 83% of their equity value, which is a substantial capital loss. However, on a deal that's acquired at a 6% going in cap rate with a loan covering just 50% of the purchase price, this same 60 basis point increase would only result in an 18% equity loss, again assuming the same market conditions throughout this period. All of this is to say that even though we may see more distress related to poor fundamentals in asset classes like office and some retail properties, we also may see quite a bit of distress in some of the strongest performing asset classes over the past few years that's directly related to short-term financing originated in 2020, 2021, and early 2022 at low interest rates and high LTV ratios, and investors not being able to refinance these assets given today's significantly less attractive lending conditions. And what makes things even more complicated is that even with these substantial drops in value at today's market cap rates, it's very likely that rates haven't actually peaked yet in many US markets, with anywhere from 20 to 40% of respondents in the survey expecting industrial and multifamily cap rates to increase by more than 25 basis points in the first half of 2023, depending on the asset quality and the business plan of the deal, and 40 to 60% of respondents expecting that office and retail cap rates will increase by that same 25 or more basis point value during this time. Ultimately, how this is all going to end up playing out will be heavily dependent on the actions of the Fed throughout the rest of 2023, but if you're trying to get a general sense of what might be next for the commercial real estate market, multifamily and industrial assets purchased with short-term financing over the last 3 years and functionally obsolete office and retail assets may be where the most distress is going to show up, and also where there might be the most opportunity to buy deals at attractive pricing and turn these assets around with the right capital structure and the right business plan. And if you want to learn more about how to actually analyze a real estate investment opportunity, and you want to learn how to build out your own real estate financial models from scratch in Excel, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification Exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on the current state of the commercial real estate market, make sure to hit the like button to let me know, and let me know in the comments your predictions for what might happen throughout the rest of the year and which asset classes you're most bullish on in 2023. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.